This week, the Treasury Department did something it almost never does. It stepped directly into the bond market and tried to talk yields down. For about a day, it worked. Then, it didn't. By Thursday, long-term yields were right back near their highs, and stocks got hit hard. But here's the part that doesn't fit the story you'd expect. While bonds were falling apart and Walmart posted its worst day in years despite beating earnings, Bitcoin was having its best week in more than 2 years. On the other side of the tech trade, Broadcom lost ground to a rival on a single headline, then turned around and announced one of the biggest debt deals in AI history. And in South Korea, two of the world's biggest chip makers crashed and rebounded, all inside 24 hours. So, was this a week the market actually lost control? Or one where different corners of it were simply pricing risk in completely different directions? I'll walk you through what happened, why it happened, and what's coming next that could settle the question.
Welcome to your weekly market recap. Everything that moved the markets this week, all in one place. Stocks, the economy, bonds, crypto, commodities, and metals. I'll break down what happened, why it mattered, and what could come next. Quick disclaimer, this is for informational and educational purposes only, not financial advice.
All three major indexes closed the week lower. The S&P 500 dropped about 1.4%, the Nasdaq fell around 2%, and the Dow slipped roughly 1%. That snapped a 3-week winning streak for the S&P and Nasdaq, and it's the Dow's second losing week in a row. The mood swung hard midweek, from cautious to genuinely anxious, before easing into Friday's close. Money rotated defensively. Healthcare names led the Friday bounce, while consumer and rate-sensitive stocks lagged most of the week. And crypto was the one clear exception to the risk-off tone. I'll get into why that matters in a bit. Why does this matter for the week as a whole? Because almost every move you're about to hear about traces back to one thing: the direction of long-term bond yields. When yields moved, stocks moved with them, almost tick for tick. Now let's get into the names that actually moved the needle. And this week, the story split right down the middle between one company that lost ground to a rival, then made a massive move to fund its future, and a retail sector that couldn't agree on anything. Start with the AI chip trade, because it was the single biggest story of the week. Broadcom fell about 5% on Wednesday after Marvell Technology landed a major custom chip deal with Google. Marvell jumped nearly 8% on the news. Google agreed to a warrant worth about $12 billion tied to future chip purchases, positioning Marvell as a real challenger to Broadcom for Google's business. That alone would have been the week's top story. But then Broadcom came back with something bigger. Reports that it's negotiating a debt financing package that could reach $70 to $100 billion to help fund AI chip infrastructure for Anthropic and other partners. So in the space of a few days, Broadcom went from losing a customer fight to taking on one of the largest debt raises in the AI build-out so far. That's not a coincidence. It tells you how much capital is now flowing into AI infrastructure and how much leverage companies are willing to take on to stay in the race. Elsewhere in chips, Micron rose about 4% on a broader memory sector rebound, tied to a buyback announcement from a major overseas peer. More on that when we get to world markets. Intel stayed volatile in the wake of its recent capital raise. Still a name to watch. Now, retail earnings. This was a split week. Walmart stock fell roughly 9%. And here's the part that should catch your attention. Walmart actually beat on both revenue and earnings. The problem was underneath the headline number. Its U.S. comparable sales growth was the weakest in years, and that's what spooked investors. When a bellwether like Walmart shows cracks in the consumer, the market pays attention, regardless of the beat. Target told a different story. Shares climbed after net sales rose more than 5%, and comparable sales beat expectations, with the company raising its full-year outlook. And the week's cleanest single-stock winner was Estée Lauder, up around 17% after a much stronger-than-expected turnaround update and a profit forecast that topped Wall Street's numbers. So here's the through line. This wasn't a week where retail moved as one block. It was a week where the market rewarded real strength and punished soft spots underneath the surface, even when the headline numbers looked fine. Let's talk about what's actually driving all of this: the bond market. The Fed released minutes from its late July meeting this week, and they were more hawkish than expected. Beyond the 3 officials who publicly dissented in favor of a rate hike, the minutes showed that many other policymakers believed a hike would likely be needed if inflation doesn't cool. Markets responded by pushing out their rate hike bets, from expecting a possible move in September to now pricing a hold that likely lasts until December. That's the headline. But the bigger story was yields themselves. Long-term Treasury yields spiked to some of their highest levels in nearly 2 decades, driven by fiscal worries as much as Fed policy. The national debt topped $40 trillion this week, and that's weighing on the long end of the curve. The Treasury tried to calm things down midweek with a pledge to more than double its buybacks of long-dated debt. Yields dropped briefly. Then, by Thursday, they were right back near the highs. So the takeaway here, the Fed isn't cutting anytime soon. A hike isn't off the table if inflation stays sticky, and the bond market is still fighting a fiscal problem that one buyback announcement isn't going to fix. Quick pause. If this is helping you make sense of the markets, a like really helps me keep making these. And don't go anywhere. There's still more ahead. Crypto, the biggest moves around the world, and what to watch in the week ahead. Now here's where the week gets interesting, because crypto did the exact opposite of everything else. Bitcoin posted its best weekly gain in more than 2 years, touching an intraday high above $79,000 on Friday, before settling back near $77,000 to $78,000. Ether rallied right alongside it, briefly moving above $2,300. What drove it? A massive short squeeze. More than $1 billion in Bitcoin short positions were wiped out in about an hour at one point this week, part of a record $2.7 billion in total crypto liquidations. When that many bearish bets get forced to close at once, it doesn't just stop the slide, it accelerates the rally, because those traders have to buy back in to cover. On top of that, U.S. spot Bitcoin and Ether ETFs pulled in more than $1 billion combined for the week, their strongest inflows since May. Add in supportive comments from President Trump on crypto legislation and a friendlier SEC proposal on token fundraising rules, and you've got a market where sentiment flipped from cautious to outright bullish in a matter of days. So while bonds and stocks were fighting yields all week, crypto was the one place risk appetite never wavered. Over in commodities, precious metals had the standout week. Gold rallied to a more than 3-month high, up around 4% for the week, driven by a weaker dollar tied to that same Treasury buyback announcement. Silver did even better, surging more than 5% and trading above $68 an ounce, its 3rd straight weekly gain. Oil also moved higher, extending a 2nd straight weekly rise, with Brent holding near $93 to $94 a barrel and WTI near $86 to $87. That move was tied to the ongoing standoff between the U.S. and Iran, which continues to raise concerns about supply out of the Middle East. Elsewhere, it was quiet. Platinum rose alongside the broader metals rally, copper traded in a narrow range with no fresh catalyst, and aluminum saw no notable move at all. The bigger picture here, gold and silver rising is a classic safe haven signal, and it lines up with everything we've talked about so far, investors hedging against currency and bond market volatility. And firm oil prices mean the inflation fight isn't getting any easier from the energy side. Let's head overseas, because this week's most dramatic single move happened in South Korea. The Kospi index plunged more than 5% on Wednesday, with Samsung Electronics down about 5% and SK Hynix down nearly 10%, as a global bond market sell-off hit chip stocks hard. Then, the very next day, both stocks reversed just as sharply. SK Hynix jumped almost 14%. Samsung rose 9%, after SK Hynix announced a roughly $28.6 billion share buyback and cancellation plan, and reports surfaced that Samsung was preparing its own shareholder return package worth more than 100 trillion won. That's one of the sharpest one-day reversals seen in the region all year, and it's the reason Micron got a lift back in the US. Memory names moved together on the news. In China, Alibaba reported a 75% drop in quarterly profit as it ramped up AI spending, even though cloud revenue jumped 45% and overall revenue slightly beat estimates. The market's reading? Wall Street is watching how much Chinese tech giants are willing to spend to compete in AI, and investors aren't fully comfortable with the price tag yet. Meanwhile, Japan's chip and AI-linked names kept outperforming, even as the broader market stayed choppy, a relative bright spot in an otherwise volatile week across Asia.
So let's connect it all, because this week really did come down to one question. Could the Treasury's move to expand debt buybacks actually calm the bond market, or was it just buying time? For about a day, it worked. Yields eased, stocks and gold both got a lift. But by Thursday, yields were climbing again. The Dow dropped roughly 700 points, and Walmart's warning added to the unease. Bitcoin didn't wait around for bonds to sort themselves out. It had its best week in years, on its own momentum, and helped drag the broader market's mood up into Friday's close. That's the real story of the week. A market where the bond problem never actually got solved, and where different assets responded to that uncertainty in completely different ways. Some defensive, some speculative, and one, crypto, just running.
Next week, all eyes are on Nvidia. It reports earnings Wednesday, August 26th after the close. And after Broadcom's rocky week and Marvell's high-profile Google deal, Nvidia's numbers will be the real test of whether the AI infrastructure spending story is still intact. Right alongside that, Wednesday also brings the core PCE inflation report, the Fed's preferred gauge, just a day before the Jackson Hole Symposium kicks off. Fed Chair Kevin Warsh is expected to give his first keynote there as chair, and given how this week went, that speech could either calm the bond market or add another leg to the pressure we just talked about. Between Nvidia and Jackson Hole, next week could end up being even bigger than this one. One last thought on the markets. Prices don't move because of the news itself. They move based on what investors expected from it. And it's the gap between expectations and reality that determines both the direction and the magnitude of the price move. If this helped you make sense of the week, a like really helps me keep making these. Subscribe and turn on the bell so you don't miss next week's recap. And leave a comment. Which market story surprised you the most this week? And did your expectations turn out to be right? I'll see you in the next recap.